A new law just passed that could reshape the dollar, crypto, and even how we spend money. But for some reason, nobody's talking about it. It's already shifting how major institutions like JP Morgan, Visa, and MasterCard use cryptocurrencies in their day-to-day operations. Jamie Dimon, the president and CEO of JP Morgan, who has traditionally been against crypto, says we're going to be involved in both deposit coin and stable coins. So if the CEO of the largest bank in the world is paying attention, then I think we should too. It's called the GENUIS Act, and it stands for Guiding and Establishing National Innovations for U.S. Stablecoins. This is the first law in American history that sets official federal rules around a fast-growing type of digital currency known as stablecoins. The legislation was passed with broad bipartisan support and signed into law on July 18th. Whether you're into crypto or not, this law will impact how everyday people interact with the financial system. Hi, I'm Rob, certified financial planner, here to help you get the best ROI out of life and your money.
So what exactly is a stablecoin? Put simply, a stablecoin is a type of digital currency used inside of the crypto ecosystem that's designed to stay close in value to a stable currency, like the US dollar. One coin equals about $1. And that's because now, under the new legislation, each stablecoin is mandated to be backed by either actual US dollars or short-term US Treasury securities. They're not meant to grow in value, and they don't earn interest. Not only do they not earn interest, but they are strictly prohibited from offering yield or interest to the holder of any stable coin. They're designed to hold value and stay stable, hence the name. They're used mostly inside of crypto accounts and digital e-commerce platforms. Let's say you trade crypto or move money through digital platforms. You don't always want to hold something like Bitcoin, which can swing wildly in price. Stable coins give you a way to hold value in digital form without exiting into traditional cash. People use them to move money quickly and cheaply, make fast payments, switch between crypto assets, and avoid volatility in the crypto markets. This isn't just a niche idea anymore. Companies like PayPal have already launched their own stablecoin, PYUSD. Now, institutions like JP Morgan, Visa, MasterCard, and other financial giants are all following suit. These are some of the largest financial institutions in the entire world. So, whether we like it or not, things are changing inside of our financial system.
Before this law, the stablecoin world was kind of the Wild West. Some issuers were regulated at the state level and others weren't regulated at all. And there was a lot of confusion over what was actually backing these so-called stable coins. If something went wrong, there weren't any clear protections for users. And so that is what the GENUIS Act is partially trying to fix. Here's what it changed. Stablecoins must be fully backed by dollars or short-term treasuries, no exceptions. Only licensed banks, credit unions, or approved companies can issue stablecoins. Issuers have to publish monthly reports showing what's backing their coins. They cannot claim to be FDIC insured or imply government protection of any kind. And if a stablecoin company fails, regular users get paid back before Wall Street creditors. In other words, the goal of this legislation is to implement clear national rules that give people more protection and clarity around how these digital dollars work. Now, if you're thinking, okay, fine, but why does this actually matter? For starters, requiring stablecoins to hold U.S. Treasuries could, in theory, help increase or at least maintain demand for U.S. debt, which is a good thing. But here's why it matters, and specifically why I believe it matters, that it doesn't sound like anybody is actually saying out loud, and especially not this administration. Thanks for joining. If you're enjoying this video, hit that subscribe button to stay tuned for more, and thanks for watching. A few months ago, the US got hit with another credit downgrade. And if that continues as our country debt rises, since we haven't started doing anything about it, especially not with the passing of this last big bill, the government would need to offer higher interest rates just to continue to convince other countries to continue buying our debt. Higher interest rates are obviously not a good thing for the prospect of reducing our country's debt. And one of the unspoken ideas behind this law is that by creating more consistent demand through stable coins backed by treasuries, we could maybe help offset the risk of less buying of U.S. debt. It's also intended to help maintain the value of the dollar and keep the dollar in place as the world's reserve currency, which is also extremely important if we're ever going to eventually start actually working on our growing debt problem. Now, how much will this help with our country's debt? I have no idea, but I don't think it hurts anything. And regardless of the underlying economical or political motivations at play here, cryptocurrencies are continuing to enter our everyday lives. And I believe that even if you're not directly invested, it's worth paying attention to. To wrap up, I think this is more than just a crypto headline. The GENUIS Act gives structure and oversight to a corner of the financial system that has been operating without any clear rules for several years now. It doesn't mean that stablecoins are risk-free, nothing like this ever is, but now there is a framework, there is some accountability, there's protection for everyday users, and the point is, that's a massive step forward for digital money's role inside of our financial system. If you're not sure how stable coins or this law fit into your financial plan, we'd love to help you figure it out. We're offering free consultations, no pressure, just guidance. There's a link in the description below that you can click to schedule a time to see how we might be able to work together. Thanks for joining us today, and I look forward to seeing you next time.